Welcome to Business 354. It's Intermediate Accounting, uh, Part 2, and we're talking about the lease chapter, Chapter 20 on leases. So, what are we going to learn about in this chapter? Well, we're going to learn about leases, and they are becoming more important for businesses as they refer to it as asset-backed financing, so or asset-based financing. So the idea is that you're basically renting equipment, and there's some benefits to do it as a rental as opposed to doing it as a purchase. So that's the first learning objective. We'll talk a little bit about what lease transactions are. So it's essentially a rental contract, and the problem is that in the balance sheet or on the balance sheet, leased assets traditionally, because they weren't owned by the company presenting the financial statements, they were left off the balance sheet. But also the more important thing was that the debt associated with the commitment to make payments for a long-term commitment would also not be included on the financial statements. So they referred to it as off-balance sheet financing. And of course, the economic substance was that they were getting most of the benefit of the asset, so it was really their asset, and they were committing themselves to a long-term series of payments, which is really a series of payments on debt. But the title at the top of the contract was a lease contract as opposed to a purchase contract. And so the accountants looked at that and said, well, really, you're purchasing an asset and you're committing yourself to a series of debt payments. You should record both the asset and the liability on your financial statements. So you shouldn't be able to record. You should not be able to fail to record the long-term commitment of payments on your financial statements. So that's kind of the evolution of the lease accounting standards. And so we'll learn a little bit about what the accounting standards are presently. There's a brand new standard, IFRS 16, and it is the new standard taking over as of January the 1st, 2019. Of course, companies are allowed to adopt it earlier than that date, but the requirements as discussed here, we'll go over the IFRS 17, which is the previous version of the standard. We'll talk about those standards and how they apply, but we'll emphasize the IFRS 16 new standards that are coming into place in the year 2019. And we'll also talk about ASPE classification. ASPE classification is the old Canadian GAAP, and it still applies for smaller private enterprises. And then we'll talk about how we actually do the accounting, so calculating lease payments, accounting for right of use assets, so that's the contractual right to use an asset for a period of time, and so that's the way that IFRS 16 treats lease issues, leased equipment. And then we'll talk about different definitions. IFRS uses the term right of use assets. ASPE uses the old terminology of capital lease to refer to those assets which give you a long-term right to use an asset, usually for most of the life or most of the value of the asset. We'll also talk a little bit about operating leases. Operating leases under ASPE are basically rentals, and so we record rent expense. And in IFRS 16, unless it's a short-term lease or a low-value lease or a lease of low-value equipment, most leases would be recorded as right-of-use assets, and so there would be an asset and a corresponding liability on the financial statements if they didn't qualify as a short-term or low-value lease. We'll compare the two methods of disclosing lease commitments. Operating leases are basically just rentals, so just rent expense, nothing on the balance sheet, just all on the income statement. Capitalization means you put it onto the balance sheet and depreciate your asset over time, over the period in which you have the right to use the asset. So capitalization means you record it as an asset and correspondingly record the outstanding liability as well. We'll talk about statement of financial position presentation of these assets and other disclosure that's required. Of course, the commitment period, the amount of the lease payment commitments would be one of those disclosures. Then we'll talk about the criteria used to determine what kind of lease it is. So the lessor has to determine whether it's a sales type or manufacturer dealer type lease. Those are the ones where there's a markup based on the sale of the asset. So they're actually selling the leased asset with a profit built in. And there's also what we used to call financing leases or direct financing leases. Those are basically just for the financing portion, and there's no markup earned by the lessor in that situation. And then we'll talk about operating leases and how those are recorded by a lessor as well. Basically, they keep the asset, so they depreciate the asset on their books, and because it's only short-term or low-value leases under IFRS, it again would not transfer the ownership of the assets and liability commitment to the lessee. We'll talk a little bit about the differences between ASPE and IFRS and what changes are expected in the near future. With the brand new standard in IFRS 16, it's unlikely that there will be any new standards. If you're interested in discovering more about leases, there's a couple of appendices to the chapter, appendices to the chapter. One talks about sale leaseback transactions. Another one talks about leases that involve real estate. So you can take a look at those if you want. So why leasing? Why do we care? Well, leasing continues to grow in popularity as a form of asset-based financing. Many businesses lease substantial portions of the property and equipment they use in their business organization as an alternative to ownership. Because leasing provides some financial, operating, and risk advantages over ownership, it's become the fastest growing form of capital investment. And this increased significance of lease arrangements in recent years has intensified the need for uniform accounting and complete informative reporting of leasing transactions. With the new IFRS standard for leases being released in January 2016, as we said, it applies for years beginning in January 2019. That is IFRS 16. It will be interesting to see if the popularity of lease financing decreases, because almost all leases will result in debt on financial statements for companies that adopt the new standard. Chapter 20 presents a discussion of the accounting issues related to leasing arrangements from the point of view of both the lessee and the lessor. And among the issues we'll discuss are the classification of leasing arrangements, the various methods used in accounting for leases, and the financial statement disclosure requirements when leases are present. So, a lease is a contractual agreement between a lessor and a lessee that conveys to the lessee the right to use specific property, either real property or a personal property, owned by the lessor for a specified period of time. And in return for that right, the lessee agrees to make periodic cash payments to the lessor, which we call the rents or the lease payments. An essential element of the lease conveyance is that the lessor conveys less than his or her total interest in the property, and so it's basically the asset of the lessor being leased out or licensed out to the lessee. The particulars of a lease agreement are dependent on the agreements entered into by the lessee and the lessor. And most lease contracts would include provisions related to the duration of the lease, the amount of the periodic rental payments, the parties required to pay taxes, insurance, maintenance, other costs, the restrictions imposed on parties to the lease, any cancellation terms, default provisions, alternatives of the lessee at the time of lease termination. So there's you have to determine at that time whether they're going to keep it and pay a purchase option price, or whether it just transfers ownership. There's a number of alternatives at the time of the lease termination. The manner in which those various provisions are used in the lease agreement helps us in determining the accounting methods used to properly portray the substance of each transaction. So in Canada, three main types of lessors. Finance companies. So finance companies that's their main source of profit, is they basically earn finance interest income on financing leases. Other independent finance companies not associated with particular manufacturers. Did I mention the first one? Honda Finance is an example of a manufacturer that finances the sale of their equipment. GM Acceptance, another large, well-known finance company. Other independent finance companies that basically do lease financing as a way of earning their income, as we said. On traditional financial institutions, banks often do leasing contracts as well to earn financing revenue. So what are the advantages of leasing? Well, in discussing the advantages of leasing arrangements, advocates often point out that leasing allows for financing of 100% of the value, because the ownership of the asset is still maintained by the lessor, so they don't have to worry about going and repossessing it. It's already their asset. I suppose they'd have to physically collect it if they were if the leasing arrangement was defaulted, but it protects the lessee against obsolescence, because they can replace the asset more quickly, and just basically let the obsolete asset, go back to the lessor. It's often less costly for the lessee because of the tax incentive for the lessor. Basically, you get to write it off. You write off the CCA, and if the CCA write-off is more valuable for the lessor than it is for the lessee, and that can be the case in a number of situations where the lessor, as a finance company, is paying a higher level of tax because they don't get the tax incentives allowed for such things as small businesses or manufacturing and processing. It's often the case that the tax benefit is higher for the lessor than for the lessee, so that reduces the cost as well. The flexibility of being able to rent an asset as opposed to buying it outright. And of course, as we talked about, off-balance sheet financing has long been a benefit of leasing, which is being constrained more strictly in more recent accounting standards. So there are a few different alternative approaches to accounting for leases. One is to not capitalize any leased assets. Use an executory contract approach, and we've talked about this in a previous course. In 353, the executory contract approach came up. Essentially, you wouldn't record an asset or liability except to the extent that it commits you to a position where you're losing money on future transactions. So some argue that because the lessee doesn't own the property, it's not appropriate to capitalize the lease at all. And so furthermore, a lease is an executory contract that requires continuing performance by both parties, and because other executory contracts, such as purchase commitments, employment contracts, are not currently capitalized, lease contracts should not be capitalized either. And so the lessor would continue to recognize the leased item as an asset, and the lessee would, jumping ahead here, and the lessee would just be recording rent expenses. Another way of viewing lease accounting is the capitalized leases that are similar to installment purchases. The classification approach, or the traditional approach of economic substance over legal form. The classification approach says that transactions should be classified and accounted for according to their economic substance, and because installment purchases are capitalized as property, plant, and equipment assets, leases that have similar characteristics to installment purchases should be accounted for in the same way. So transactions not recognized as in-substance acquisitions of assets are classified as operating leases and accounted for essentially on the income statement. So that's the traditional lease approach under Canadian GAAP, and it still is carried forward under ASPE standards. The third option, the capitalize all leases, a contract-based approach, basically says we record the right to use the asset as it's described in the lease. So we don't record the asset itself, but the right to use the asset has long-term benefits, and as such should be recorded as a contract-based asset, a contractual right to use the property. So under this approach, the leased asset that is required is acquired is not the physical property, it's the contractual right to use the property that's conveyed under the lease agreement, and so the liability is the contractual obligation to make lease payments. Under this view, also called a property rights or right of use approach, it's justifiable to capitalize the fair value of the rights and obligations associated with a broad range of leases. And so the only ones that would not be included as a long-term asset with a long-term financial obligation associated with it would be short-term leases and low-value leases, essentially arguing from materiality that it's not important enough to worry about those ones. So what are the current standards? The current standards, being followed by most lessees under ASPE and IAS 17, are consistent with the classification approach that capitalizes leases that are similar to an installment approach or installment purchase. And so they're called capital or finance leases, and usually are recognized as items of property, plant, and equipment. And the accounting treatment is based on the concepts that a lease that transfers substantially all the benefits and risks of property ownership should be capitalized. So the newly introduced lease accounting requirements under IFRS are different. They are contract-based, and they have a goal of capitalizing almost all leases for lessees. So by capitalizing the present value of the future rental payments, the lessee records an asset and liability at an amount that is generally representative of the asset's fair value. The lessor, having transferred substantially all the benefits and risks of ownership, removes the asset from its statement of financial position and replaces it with a receivable. So the lessor no longer has the asset, it has a contract receivable payment, a series of payments from the lessee. The journal entries for the lessee and the lessor under ASPE and IAS 17, assuming the leased equipment is capitalized, are, well, we're going to be discussing them in assignment questions and possibly, and also later in our discussion. So if the benefits and ownerships are not transferred from one party to the other, the lease is classified as an operating lease. And under ASPE, a capital lease, you would record, you debit equipment under lease and credit obligations under lease to recognize the asset that you're using and the obligations as a long-term liability. And then as you use the asset over time, you would record depreciation expense and accumulated depreciation for leased equipment. You would pay off your obligations under lease using essentially the effective interest method. You'd record interest expense and a reduction in cash. And so as the lessee, you would record depreciation expense and interest expense rather than rent expense. Under an operating lease, you're just renting the equipment, so you would just record rent expense and a reduction in cash. On the lessor's side, they would set up a lease receivable and reduce the equipment that they own because under the lessor's leasing contract, they no longer own the equipment. The equipment has been effectively transferred to the lessee. So current accounting standards would include the fact that the lessor doesn't any longer have the equipment shown on their balance sheet. And they would record, when they received cash, they would record an interest income amount and a lease receivable to recognize the principal of the loan. Now, on the other hand, if it's an operating lease, they would keep the equipment on their books and they would record rental revenue when they received cash from their lessee. So when the asset is capitalized as an item of property, item of property, plant, and equipment, the lessee recognizes the depreciation. The lessor and the lessee treat the lease rentals as the receipt and the payment of interest and principal, and if the lease isn't capitalized, no asset is recorded by the lessee and no asset is removed from the lessor's books. When a lease payment is made, the lessee records rent or lease expense and the lessor recognizes rental or lease income. So you need to determine whether the asset is a capital or finance lease or whether it's an operating lease. The contract-based approach of IFRS 16 is based on the view that lease contracts create assets and liabilities that should be recognized in the financial statements of lessees, even if they don't recognize the transfer of the physical property itself. The right to use the asset is an asset in its own right. So, under the new approach, the contract-based right of use approach, aside from short-term leases and leases for low-value items, all the leases covered by the new standard would be recognized as right of use assets, along with the contractual obligation or lease liability to make lease payments in the future. Let me pause for a second. All right, we're back. So, looking at the IFRS approach, almost all leases are capitalized, and almost all leases would record a long-term asset and a long-term liability. So, we need to be able to make an assessment as to whether an asset fits the definition of an asset that should be capitalized or not. So under IFRS 16, companies must assess whether each contract they enter into whether each contract they enter into is or contains a lease. The definition is a contract is or contains a lease if the contract conveys the right to control the use of an identified asset for a period of time exchanged for consideration. So instead of a period of time such as months or years, a lease can also be described as by the extent of use of the asset, such as the number of units that a piece of equipment produces. Kind of like photocopiers, but photocopiers are generally fairly low value items, so often they would meet the low value requirement for not capitalizing them. But that kind of contract could result in a lease contract defined by the extent of use of the asset. So while the goal is initially to recognize the assets and liabilities for the rights and obligations of all leases, exceptions would be recognized in IFRS for short-term leases, 12 months or less, or for leases where the underlying asset is of low value. And where one of these two exceptions is made, the lessee recognizes the lease payments as an expense, rent expense, on a straight-line basis over the lease term, or by some other systematic approach of recognition. So these short-term and low-value leases exceptions are treated in a similar manner to the accounting for operating leases by lessees under ASPE and the current IAS 17. ASPE leases criteria accounting for lessors is substantially the same under IFRS 16 as it was under the pre-existing rules of IAS 17. And a classification approach is used to classify leases as a finance lease. This is accounting for the lessors, so that's accounting for the party that legally owns the asset and has given the right of use to the other party. So a classification approach is used to classify leases as either a finance lease, if it substantially transfers the risks and rewards of ownership from the lessor to the lessee, or to classify it as an operating lease if the risks and rewards are not substantially transferred. And ASPE focuses on the transfer of risks and rewards of ownership for classification of leases for both lessees and lessors. So we need to identify whether or not the risks and rewards of ownership are transferred from the lessor to the lessee. So how do we do that? Well, the ASPE criteria fall into these categories, the following categories. ASPE assumes the risks and benefits of ownership are normally transferred to the lessee if one of three things is true. So the lessee must classify and account for the arrangement as a capital lease if any one of the or more of the following criteria is met. If there is a reasonable assurance that the lease will obtain ownership of the leased property, including through a bargain purchase option or a title transfer at the end of the lease, or something to indicate that that ownership will likely transfer. The lease will benefit from most of the asset benefits. So if it's more than 75% of the leased property's economic life, we assume that the risks and benefits of ownership have transferred. or if the lessor recovers substantially all of its investment and earns a return on its investment in the leased property, where the present value of the minimum lease payments is substantially all of the fair value of the leased assets. So substantially all usually means 90%. So a numerical threshold is included. It's usually assumed that if the present value of the minimum lease payments equals or exceeds 90% of the fair value of the leased asset, that the benefits and risks of ownership have been transferred to the lessee. So under ASPE, those numerical thresholds tend to be the key decision criteria, either title transfer with a bargain purchase option or actual title transfer, 75% of the life or 90% of the value, the fair value. So all leases that fail to meet any one of the three criteria, or at least that fail to meet the criteria, any of the three criteria, are classified and accounted for as operating leases with rental expense. So the transfer of ownership test under ASPE, the criteria is straightforward, easy to apply in practice. The transfer may occur at the end of the lease term with no additional payment or through a bargain purchase option. A bargain purchase option is a provision that allows the lessee to purchase the leased property for a price that's significantly lower than the asset's expected fair value when the lessee can exercise the option. And so at the beginning of the lease, the difference between the option price and the expected fair value in the future must be large enough to make it reasonably sure that the option will be exercised. The economic life test under ASPE, if the lease period is equal to or greater than 75% of the asset's economic life, it's assumed that most of the risks and rewards of ownership are going to accrue to the lessee. The recovery of investment by the lessor test, the rationale for that, for the recovery of the investment by the lessor, is that if the present value of the payments is reasonably close to an asset's market price, the lessor is recovering its investment in the asset plus earning a return on the investment through the lease. And so we calculate the minimum lease payments under ASPE, and they would include the minimum rental payments, any amounts that are guaranteed under the lease, any executory costs which are paid to the lessor, and we need to determine the appropriate discount rate. So minimum lease payments, minimum rental payments plus amounts guaranteed plus any bargain purchase option at the end. Minimum rental payments would include regular payments to the lessor, including, where am I going with this? Minimum lease payments for the lessee are defined as minimum rental payments, which would include any regular payments made to the lessor, except for executory costs. So insurance, maintenance, and tax expenses, those expenses should be separated out and treated in their nature, in the nature of the expenses, and they would be excluded from the minimum rental payment calculation. Guaranteed amounts would include a guaranteed residual value. So if the lessor or if the lessee guarantees a certain value for the leased asset at the end of the lease term, then it would be added to the minimum lease payments. For the lessee, the maximum the amount the lessor can require the lessee to pay at the end of the lease would be included as part of the minimum lease payments. And the amount of the bargain purchase option, if it requires an additional payment well below the expected fair value, the bargain purchase option cost would be included as well, because it would be irrational for them not to exercise the bargain purchase option. Even if they didn't plan to keep the asset, they would purchase it and then sell it at its fair value. The discount rate. So what discount rate should be used by the lessee in determining the present value of the minimum lease payments? Well, if you know the rate implicit in the lease, it would be the lessor's internal rate of return at the beginning of the lease that makes the present value of the lease payments plus any unguaranteed residual values equal to the fair value of the underlying leased asset. So it would be the rate that the lessor would use in pricing the lease. Or it could be the lessee's incremental borrowing rate if they don't know the lessee's rate implicit in the lease. The interest rate that At the beginning of the lease, the lessee would incur to borrow funds needed to purchase an asset of similar value, assuming a similar term and similar security, what rate that they would have access to as well. So they would get a quote from the bank essentially as to what it would cost them to finance the lease, other than through the lessor's contract. Under IFRS, as it points out, you would use the rate implicit in the lease if you can determine it. Under ASPE, you'd use the lower of the two rates, and ASPE would specifically note that the leased property couldn't be capitalized for more than its fair value. So it's kind of a cap or a maximum amount. So there's actually a provision where they can't record it as more than its fair value. Okay. Let's just step back here for a second. Okay, determining the rental payments. The lessor would set the rental payments to earn a specific rate of return, their implicit rate of return, on the lease contract. And if there's a bargain purchase option or a guaranteed residual value, those components wouldn't need to be recovered through rental payments, and so they would be recovered through the return of the asset or through the payment of the bargain purchase option. So IFRS refers to purchase options reasonably certain of being exercised. So that would include bargain purchase options, but it might include other purchase options that, for whatever reason, you think are reasonably certain of being exercised. So the terms used are slightly different. The accounting model under IFRS 16 is contract-based, similar to the approach first introduced for revenue recognition back in Chapter 6 of Volume 1. So the lessee recognizes a right of use asset representing its right to use the leased items over the lease term, along with a lease liability that captures its obligation to make lease payments. And under the classification approach, the lessee recognizes a lease as the leased property itself when there is a transfer of the risks and benefits of ownership. So ASPE recognizes the property. The contract-based approach under IFRS 16 recognizes the right to use the asset as the asset that you're purchasing through the lease contract. The contract-based approach sees the asset itself as the right to use the asset. So that approach is much broader, capturing a lot of arrangements that are, if they're not specifically equipment-based, they may be treated as operating leases under the current accounting standards, but because IFRS looks at the right to use assets as an asset itself, we would record a lot more lease assets and liabilities than we have in the past. Back to the idea of rental payments. If we have an example, a lessor corporation wants to earn a 10% return on its investment of $100,000, and the lease is for 5 years. Annual rental payments are due at the beginning of each year, and so be careful with that. Lease payments are often due at the beginning, which means that you have to calculate using the begin mode on your financial calculator, which is a little tricky. And make sure you, of course, when you're done the calculation, you switch it back to end mode. Any bargain purchase option or purchase option at the end of the lease would be added as a future value in your financial calculators. So to calculate the payment required to provide the lessor with a required rate of return, we would do the calculation. The cost of the asset to be recovered is $100,000. There's no expected residual value. So $100,000 is the amount that we need to recover through the lease payments. So calculate the present value of the annuity due. N is 5, I per Y is 10%. The index rate would be 4.16986, or just put $100,000 as future value and zero payment, and calculate zero present value, and calculate the payments. That's $23,981.62. So there would be 5 lease payments, $23,981.62 each, for a total of $120,000. So obviously $20,000 of that is interest. Okay, so at the inception of the lease, the asset is recognized initially at cost and based on the present value of the lease payments, which we just calculated. So that includes variable payments. If there are contingent payments over the term of the lease, contingent rent payments would be something based on some other index or variable, some other thing that would change the amount of the potential lease payments. So that's one question you have to ask. Do contingent rentals, additional rentals that become payable based on the level of a price index or some other variable, do they have to be considered? That's one of the things we need to think about. So under the contract-based approach, assets and liabilities arise and are recognized at the start of the lease contract, and at that point the right of the use asset and the liability to make the lease payments are usually equal. The liability recognized by the lessee is measured at the present value of the lease payments, and while that sounds fairly straightforward in our calculations in the past, we'd have to make a number of decisions about that, and so one of them is the contingent rentals. The second, are there guarantees of residual values at the end of the lease, and are they factored into the calculations? Thirdly, lease contracts often contain renewal or purchase options, sometimes at bargain prices and other times at market rates, or they may contain options to end the lease early. Are those considered? What discount rate should be used for the liability to make lease payments? So there are a number of issues that we need to address when we're doing the accounting. So the lease term is generally considered to be the non-cancelable period for the, well, let's step back a second here. The new proposals in IFRS 16 take the position that the contractual obligation to pay rent includes variable payments for the lease, such as those under Consumer Price Index or some other index. And it also includes other contingent payments over the term of the lease, such as amounts expected to be payable by the lessee under residual value guarantees. So those are included in the rental payments. So therefore, such amounts need to be estimated in advance. They're measured using expected values and are included in the lease payments as part of the initial lease liability, which is recognized. Note, however, it's only the cash flows that are expected to be made in the future related to these items that are included, not the full amount of the residual value, because the full amount of the residual value, for example, unless it's expected to be the amount of the residual value deficiency. So if they're expecting to have a residual value payment made based on the asset value being something less than that residual value, the cash flow would be included as part of the rental payments. The value of the asset itself would not, because the asset belongs to the lessee or the lessor. Payments for the exercise of purchase options are included only if it's reasonably certain that the lessee will exercise that option. An associated issue is determining the term of the lease, and that decision in turn affects the number of periods over which the lease payments and contingent rentals are payable, as well as the amount of any residual value deficiency or purchase option amount expected to be received. Taking all those relevant factors into account, the lease term is generally considered the non-cancelable period of the lease. However, this period is extended if the lease is reasonably certain to exercise an option to extend the lease because of its terms and conditions compared with the market rates for similar leases, such as the amount of payments during the renewal period, purchase options exercisable after the initial option period, termination penalties, etc. So if you would like to investigate that more thoroughly, look at IFRS 16 paragraphs B37 to 41. The third variable in measuring the lease payments is the discount rate itself. And we've discussed that above. IFRS 16 requires use of the rate implicit in the lease if it could be readily determined. Otherwise, the lessee's incremental borrowing rate should be used. So, accounting for a right of use asset. The asset recognized under the contract-based approach is measured initially at cost based on the present value of the lease payments as described above for the lease contract. And consistent with the cost model, any of the lessee's initial direct costs of negotiating and arranging the lease are also capitalized, as are the costs of dismantling and removing the underlying asset and restoring the site, All of those are part of the cost of the right of use asset. So after recognition, we need to recognize the lease liability. The lease liability is accounted for at amortized cost using the effective interest method. So as lease payments are made, the lease liability is reduced with each payment separated into interest and principal reduction amounts. Interest is calculated using the original discount rate established when the lease liability was first recognized and applied to the outstanding principal balance. We're fairly familiar with the effective interest rate method now. So the estimates used to determine the lease term and the contingent rental amount, such as the amount expected to be payable under any residual value guarantee, are reassessed at every reporting date. So you need to redetermine whether those things had changed when you're preparing your financial statements. So the journal entries you would do at the inception of the lease, you would record right of use asset and credit the lease liability and record generally the first payment happens immediately. So cash would be going down. And then at each balance sheet date, you would accrue interest. So you record the interest expense and increase the liability when you actually made the payment. At the bottom, you would record the lease payment, reducing the lease liability and recognizing the cash. You would also recognize the depreciation of the value of the asset. So record depreciation expense and accumulate depreciation using whatever appropriate method you normally use for assets of that kind. So here's an example. We have a lease term of 4 years. It's non-cancelable during that period. Annual payments are $5,000 at the beginning of the year, starting September the 1st, 2018. The fair value of the asset at 3 different time periods, or 3 different dates: August 31st, 2018, which is the day before we enter into the lease. Then 2022, 4 years later. 2024, 6 years later. Would be $24,000 at the beginning, $6,000 at the end of the lease, and $1,000 2 years after the lease. Our probability weighted expected value of the residual is $1,000 after 6 years, which is essentially what we've just talked about, the fair value of the asset. The lessor's initial direct costs are $365. The lease has a renewal option, which will likely be taken to renew the lease for 2 additional years at $4,500 per year. The lessee's incremental borrowing rate is 9%, which is also the rate implicit in the lease. The title is retained by the lessor, but that, of course, doesn't matter because it's the right to use the asset that we're recording. So the entry to record the initial lease transaction, the right of the use asset, is $23,769, which is the present value of the series of $5,000 payments plus the 2 $4,500 payments. The lease liability is the same amount less the cash that is received, as the first payment is made immediately. So since it's a right of use lease, the following needs to be recorded at the year end. And every time you do a balance sheet, basically interest expense and asset depreciation would be recorded as expenses on the income statement. The entry to record the interest on December 31st, 2018 would include interest expense of $563, which is the I think there's a typo, $23,769 minus $5,000 times 9% times 4/12. So from September 1st, September, October, November, December, 4 months of interest expense based on the remaining principal at the beginning. So I think that should be $23,769, not $23,969. The entry to record depreciation would be based on the $23,769 divided by 6 years, because that's their expected term to use the lease. So we use the entire term of the lease to amortize the asset because the most likely lease term includes those 2 additional years for the renewal option. Accounting for residual values. Actually, let's step back here for a second. A little bit more information on the depreciation method. When you've capitalized the asset, the cost is essentially allocated over its useful life. So you need to understand the terms of the lease and what's included in the capitalized value to determine the depreciable amount and its useful life. So for example, if it's a simple lease that transfers title to the asset at the end of the lease term for no additional payments, then the full capitalized value less any estimated residual value at the end of its useful life to the lessee is depreciated over the full useful life of the entity. If the lease contains a purchase option that's reasonably certain to be exercised, the assumption is that the lessee will acquire legal title to the asset, and so will continue to use the asset. Once again, the entity allocates the full capitalized cost over the full useful life of the asset, just like it would any other asset. It's a matter of thinking about it in terms of what physically happens to the asset. So now consider a situation in which the lessee is obligated to make rental payments over the lease term and then return the asset to the lessor in whatever condition it's in at that time. All that would be capitalized are the lease payments because this is all the lessee is responsible for paying, and in that case the full capitalized value is amortized over the time to the end of the lease. This changes if the lessee also takes on an obligation to guarantee the residual value of the asset at the end of the lease. So it changes if the lessee also takes on an obligation to guarantee the residual value of the asset at the end of the lease. So now the capitalized value includes the present value of the amount of the residual value guaranteed, expected to be payable by the lessee. So if they expect to have a shortfall in that value, the cash flow for the residual value guarantee would be what you're focusing on under IFRS 16, or under ASPE it would be the guaranteed residual value, the equipment plus any shortfall. So now what will the entity depreciate? Because the leased asset at the guaranteed residual value is expected to be returned to the lessor, the lessee depreciates only the capitalized amount less the guaranteed residual amount over the period to the end of the lease. Look at illustration 20-8 in your text, which summarizes depreciable amounts and depreciation period, and be sure that you can understand the reason for each of those items. Maybe I'll add that in here, maybe not. Illustration 20-8 describes all of the parts that are included in the capitalized asset cost, the depreciable amount, and the depreciation period under different assumptions. So for example, if the asset reverts to the lessor at the end of the lease term, the lessee doesn't guarantee any residual value, then it's just the minimum rental payments that are included in the capitalized asset cost. The full capitalized amount is depreciated over the lease term. So if the residual value is guaranteed by the lessor, the present value would be included in the leased asset and lease obligation recognized. If the residual value is unguaranteed, it's not included in the leased asset and the lease obligation recognized by the lessee. What about purchase options? Lessee accounting assumes a bargain purchase option under IFRS. A purchase option that's reasonably certain to be exercised. Note the difference in language. That a bargain purchase option or a purchase option reasonably certain to be exercised will be exercised. So you would treat the accounting based on that assumption. So the exercise price of the purchase option would be included in the lease payments. Its present value would be included as part of the asset cost in the lease obligation. And the asset would be amortized over its economic life, not just the lease term. So if you assume that the purchase option will be exercised, then the life of the asset would be the entire economic life of the asset. Finally, let's look at accounting for an operating lease. In a lease agreement where the risks and benefits of ownership of the leased asset are not considered to be transferred to the lessee under ASPE, or where an exemption for a short-term lease or leases for low-value assets under IFRS 16 exempts those from capitalization treatment, then a non-capitalization method is appropriate. And under that type of lease, neither the leased asset nor the obligation to make lease payments is recognized in the accounts. It's treated like an executory contract. The lease payments are treated as rent expense for an operating lease or short-term lease expense or low-value lease expense for exempt items under IFRS 16. The journal entry the lessee would make to record the operating lease would be just a debit to rent expense and a credit to cash. Both ASPE and IFRS agree that lease rentals are recognized on a straight line basis over the term of the lease, unless there's another systematic basis which better represents the pattern of the benefits received. The total expenses over the lease term would be the same, regardless of the accounting method, whether it's operating or capital, but the timing expenses changes because capital leases would record interest expense and depreciation, so capital leases would result in higher expenses in early years, lower expenses in later years compared to operating leases. Operating leases result in lower debt equity ratios because of the off-balance sheet financing, and improved total asset turnover and return on total assets numbers because the capital lease expenses being higher in the early years would be a detriment to the total asset turnover. And the where am I going? Let's back up here. Improved total asset turnover and return on total assets would reduce the amount of assets that are invested, so the total asset turnover and return on total assets would be higher relative to capital leases because the asset isn't recorded on the lessor's books. Current versus non-current, just like other financing obligations, current portion should be shown as a current liability, long-term should be shown as a long-term liability. So any principal not payable within the next 12 months would be a long-term liability. Disclosure items. The classification of the lessee's lease liability would be determined by the date of the principal payment, just like any other one. Other disclosure issues, because the right of use or capital leases recognize the leased asset and a long-term liability, most of the required disclosures are identified in or similar to those in the standards that cover property, plant, equipment, other intangible assets, impairment, financial instruments, long-term liabilities, all the things we talked about before in other chapters. IFRS requires additional disclosures for the carrying amount of right of use assets at the end of the reporting period by the class of the underlying asset. They require a maturity analysis of lease liabilities separately from the maturity analyses of other financial liabilities, so lease liabilities would be treated differently than other financing. Additional qualitative and quantitative information about leasing activities to help users assess the nature of the company's leasing activities, the obligation to pay future cash outflows, restrictions or covenants imposed by the leases, and any sale and leaseback transactions because of the nature of the risk involved. For operating leases, in a lease agreement where the risks and benefits of ownership of the leased asset are not considered to be transferred to the lessee under ASPE, or when exemption for short-term or low-value assets under IFRS 16 is chosen, a non-capitalization method is appropriate. So under that type of lease, neither the leased asset nor the obligation is recognized in the accounts and is treated as rent expense. So lessees must include the future minimum lease payments extending in the future and additional disclosure regarding the various lease terms, any conditions or risks, contingent rents, subleases would be included as well. Followers of IFRS 16 have additional required disclosures for operating leases. IFRS requires additional disclosures related to the carrying amount of right of use assets at the end of the reporting period. We already talked about this. Bouncing around in my notes here. Existing standards for operating leases, both ASPE and IFRS require disclosure of the minimum lease payments for the operating leases extending into the future. Private enterprises report the total at the balance sheet date and those payable for each of the next 5 years. ISS 17 requirement is similar to that and extends the disclosures to include a description of the significant lease arrangements and information about subleases and contingent rents For those following IFRS 16, companies are required to disclose the expense relating to short-term lease exemptions, the expense relating to low-value lease exemptions, and the amount of lease commitments for short-term leases if the short-term leases committed to are dissimilar from the portfolio to which short-term expense relates. So anything that describes differences in the lease commitments over time. Now moving on to lessors. From a lessor's standpoint, all leases are classified for accounting purposes as shown below under ASPE. Operating leases are called operating leases as they are under IFRS, but the long-term leases or capitalized leases would be treated differently. A sales type lease under ASPE is referred to as a sales type lease. Under IFRS, the term is a manufacturer or dealer lease. The idea there is that there's a profit. When you sell the asset, you make a profit, and then you make further profits later through financing, and you separate the financing revenues from the gross profit earned on the sale of the asset. Financing type leases were called direct financing leases under the old CICA, so that's the term in ASPE. Finance leases is the term used in IFRS to recognize that the source of revenue being tracked is financing. So lessor accounting under IFRS 16 is consistent with the existing accounting for lessors under IAS 17. So accounting for lessees changed significantly under IFRS as detailed above, but accounting for lessors is largely unchanged. When comparing IFRS 16 and IAS 17, the lessor considers the same factors as said under ASPE or IAS 17 as the lessee in determining whether the risks and benefits of ownership of the leased property are transferred. If they're not transferred to the lessee, the lessor accounts for the lease contract as an operating lease. If the risks and benefits ownership are transferred to the lessee, the lessor capitalizes the lease as either a manufacturer or dealer lease or a finance lease, as described in this slide. Under IFRS, the criteria to assess whether a lease is an operating lease or a financing lease are identical to the criteria used by the lessee. So you can look at Appendix 20B if you would like, with one minor exception under IFRS 16. Instead of the term bargain purchase option, they refer to the option being reasonably certain to be exercised. Under ASPE, the same criteria are also used with the addition of 2 revenue recognition-based tests that must be passed. So from the lessor's perspective, is the credit risk associated with the lease normal when compared with the risk of the collection of similar receivables? And can the amounts of any unreimbursable costs that are likely to be incurred by the lessor under the lease be reasonably estimated? So are there any hidden expenses out there that are not likely to be recovered? If collectability of the amounts that are due under the contract is not reasonably assured, or if the lessor still has to absorb. Okay, we bounced already made our way past these ones. A little bit tricky to keep my notes in sync with the slides that we're going through. Let's just continue our discussion here of the ASPE rules. If collectability of the amounts that are due under the contract is not reasonably assured, or if the lessor still has to absorb an uncertain amount of additional costs, then it's not appropriate to remove the leased asset from the lessor's books because they're still bearing risk related to that asset. So they wouldn't recognize rental revenue. They would recognize revenue when the issues of collectability and uncertainty of future costs were resolved, just as we discussed in the revenue recognition previously in the course. So in short, if any of the 3 ASPE criteria used by lessees for classification of a capital lease is met, and the answer to both of the additional 2 questions is also yes, then the arrangement wouldn't be treated as an operating lease. It's either a sales type or direct financing lease. So how do you distinguish between a manufacturer or dealer lease, sales type lease, and a financing type lease? Well, this depends on the specific situation. Some manufacturers enter into lease agreements either directly or through a subsidiary captive leasing company, like the Honda Finance mentioned before, or General GM Assurance. And it's a way of facilitating the sale of their product. So these transactions are usually manufacturer, dealer, or sales-type lease arrangements. Other companies are in business to just provide financing to the lessee for the acquisition of a variety of assets in order to generate financing income, and they're called direct financing leases under ASPE, finance leases under IFRS. The difference between these two classifications is the presence or absence of the manufacturer or dealer's profit or loss. A sales-type lease, manufacturing dealer's lease, includes in the rental amount the recovery of a manufacturer or dealer's profit, as well as the asset's cost. The profit or loss to this lessor is the difference between the fair value of the leased property at the beginning of the lease and the lessor's cost or carrying amount, the book value. As indicated earlier, manufacturer or dealer or sales-type leases normally arise when manufacturers or dealers use leasing as a way of marketing their products. Direct financing leases, on the other hand, generally result from arrangements with lessors that are engaged mostly in financing operations, lease finance companies, financial intermediaries, banks, or finance subsidiaries. These lessors acquire the specific assets the lessees have asked them to acquire, and then their business model is to earn interest income on the financing arrangement with the lessee. So all leases that are not financing or manufacturer dealer, sales-type leases are classified and accounted for by the lessor as an operating lease. Under ASPE, when both revenue recognition criteria are not met, it's possible that a lessor will classify a lease as an operating lease, while the lessee will classify the same lease as a capital lease. When this happens, both the lessor and the lessee would carry the asset on their books, and both would depreciate the capitalized asset. Accounting for financing and manufacturer-dealer sales-type leases. A lessor should account for an operating lease using the operating method. The distinction between a direct financing lease and a sales-type lease concerns the fact that a sales-type lease involves the manufacturer's or dealer's profit, and a direct financing lease doesn't. The primary difference between applying the financing method to a direct financing lease and applying it to a sales-type lease is the recognition of the manufacturer or dealer's profit at the inception of the lease. The profit or loss to the lessor is evidenced by the difference between the fair value of the leased property at the inception of the lease and the lessor's cost or carrying amount, the book value. Under the operating method, every rental receipt of the lessor is recorded as rent revenue on the use of an item carried as a fixed asset. The fixed asset is depreciated in the normal manner, with the depreciation expense of the period being matched against the rental revenue. So from the point of view of the lessor, they record it as rental revenue and depreciate the asset normally. Leases that are in substance the financing of an asset purchased by a lessee require the lessor to substitute a lease payments receivable for the leased asset, and so lessor accounting under such a capital lease arrangement would require computation of the gross investment in the lease, unearned interest revenue, and net investment. Gross investment would be the sum of the minimum lease payments plus any unguaranteed residual value accruing to the benefit of the lessor. The net investment in the lease is the present value of the gross investment, or the gross investment less the unearned interest. Unearned interest revenue, represented by the difference between the gross investment and the in the lease recorded as the receivable and the cost of the carrying value of property, is depreciated to revenue over the lease term by use of the effective interest method. So you would set up unearned interest revenue as the difference between the gross and the net investment in the lease, and you would bring it into actual interest revenue as you earned it under the effective interest method. Any contingent rentals, including rentals based on variables such as prime interest rate, sales volume, are credited to income when they become receivable. The text material includes a complete illustration of the accounting entries that a lessor would make for a direct financing lease, similar to the long-term financing we talked about earlier. Preparation of a lease depreciation schedule is an effective way to provide all the information necessary for the required journal entries. Leases have certain characteristics that create unique accounting problems, and those problems have been addressed in section 3065 of ASPE, the CPA Canada Handbook. And under sales type leases, the profit recorded by the lessor at the point of the sale is the same whether the residual value is guaranteed or not, but the sales revenue and cost of goods sold amounts are different. So the present value of the unguaranteed residual value would be deducted from both the sales and the cost of goods sold. So here's an example, and The example includes a lease term of 5 years, non-cancelable, annual payments 25981.62. At the beginning of each year, starting January 1st, 2017, the fair value of the assets $100,000. The economic life is 5 years. No residual value is expected. Lease payments includes $2,000 of executory costs, which is the maintenance fee. The lease has no renewal option. The asset reverts to the lessor at the termination of the lease. The lessor's implicit rate, which is the required return that they earned on the investment, would be 10%. Of course, they would know that, being the lessor. Collectability is reasonably assured and no additional costs expected to be incurred. So the entry to record the inception of the lease. You buy the equipment acquired for lessee, and debit credit cash. You set up the lease receivable. $120,000 is the present value of the lease payments. Sorry, I'm lying to you. The lease receivable would be the gross investment, so the $25,981.62 total payment minus the $2,000 which are allocated to maintenance expenses would be multiplied by 5 for 5 payments. The total amount paid is $119,908. The equipment acquired for the lessee would be reduced by $100,000, and the difference would be the unearned interest income. So the net investment in the lease would be the $25,981.62 minus $2,000 as the annual payment, with n is equal to 5, I is equal to 10%. Take the present value of that, and you would get $100,000. And once again, the $2,000 is deducted because that's the executory costs. The first payment, you would pay cash for $25,981.62, so the lessor would receive it. You would reduce the lease receivable by $23,081.62, which is the amount of the payment that you're expecting. So the lease receivable includes the gross investment, so the total value of all the payments on a nominal basis. You'd record maintenance and repairs expense of $2,000. You'd record a reduction in maintenance and repairs expense. So presumably the lessor is doing the maintenance expense and being paid by the lessee. And so the cost of the expense would be recorded through salary and parts costs and all those sorts of things in other expenses for the lessor. And then when they receive the money from the lessee, they would reduce their maintenance and repairs expense accordingly. And then they would also record an accrual of interest earned on December 31st, 2017. The unearned interest income would be $76,0184, which would be the $100,000 times the interest rate, which I forget what it was, 10%, but allocated for the shorter period of the year, so it's allocated. Okay, so why would that be? 10%, January the 1st is the first payment. Okay, so why would it be $76,0184? That's not making a lot of sense, because we set up the present value of the net investment of the lease is $100,000, which is presumably the principal, and we're paying 10% on that. Okay, so they're going to tell us here. The calculation of the interest earned on at December 31st, 2017. The amount originally financed, $100,000. Oh, the payment on principal. The first payment. Sorry. So the first payment is reduced from principal right at the beginning. That makes sense. So the balance outstanding is not $100,000, but it's $76,018, and so 10% of that for the full year is $76,001. That makes sense. Your financial statement presentation, you would have an asset. The net investment in finance leases would be $23,982, the current portion, and the long-term portion would be $59,639, because the $23,982 represents the January 1st, 2018 payment, and the other payments are shown as non-current assets. Now, what if we adjusted the example to sales type lease? Sales type lease, basically you're looking at the same entries as the financing type lease, except for the entry at the inception of the lease must record the sale and the cost of goods sold, so you get the gross profit. You would recall the sales type lease includes the profit margin. ASPE uses terminology calling it a sales type lease. IFRS uses the terminology manufacturer or dealer lease, depending on whether you're the manufacturer or the dealer. The lessor earns a gross profit on the sale plus the interest as the sale is financing, so two sources of revenue. So it's the same data as the finance type lease, except we'll assume that the asset has been recorded in the lessor's inventory at a cost of $85,000, so they're making a $15,000 profit with a fair market value of $100,000. All the previous lessor entries remain the same except for the entry at the lease inception when we record the sales and cost of goods sold. So the entries to record the inception of the lease receivable is the same, just the gross amount of all of the rental payments less the executory costs. Then credit under interest income for $19,908 and record the sales amount of $100,000, the fair market value of the asset. Then the cost of goods sold inventory goes down by $85,000, so the expense for cost of goods sold is $85,000. Then the first payment, $25,982, paid on January the 1st, 2017. It's the same. Unearned interest is the same, and so on. Accounting for residual values, whether it's guaranteed or unguaranteed, the residual is included in the lessor's calculations of both financing type leases or sales type leases because they're going to get that value, they're expecting to get that value. The accounting results is exactly the same whether the situation involves the residual value or a bargain purchase option that's reasonably certain to be exercised. The difference is that the residual value would be reduced from both the sales and the cost of goods sold. Sales and cost of goods sold are recognized only for the portion of the asset that is sure to be realized, so the gross profit amount would be the same whether the residual value is guaranteed or not, but the present value of any unguaranteed residual is not included in the calculation of either the sales amount or the cost of goods sold. Initial direct costs. Initial direct costs are the costs incurred by the lessor that are directly associated with negotiating and consummating a completed lease transaction. They include commissions, legal fees, costs of preparing and processing documents. These initial costs are treated somewhat differently under ASPE and IFRS, but the resulting difference in reported income and assets is not material. So we're not going to spend a lot of time looking at the treatment of these costs. Basically, they're accounted for similar to other costs in that the costs are matched with the revenue of the accounting period benefiting from the lease. Two types of initial direct costs: incremental direct costs and internal direct costs. Incremental direct costs are costs incurred in originating a lease agreement that are paid to a third party, and internal direct costs are costs directly related to specified activities performed by the lessor on a given lease. When operating lease is present, we defer and depreciate the initial direct costs over the life of the lease in proportion to the rental income. In a sales type lease, these costs are expensed in the period that profit on the sale is recognized. Financing type leases, initial direct costs are recognized in a manner that are spread over the life of the lease. Disclosure under ASPE. The specific disclosure requirements are related to the specific disclosure requirements under ASPE related to a lessor's involvement in financing and sales type leases are limited to disclosure of the entity's net investment and the interest rate implicit in them, as well as the carrying amount of any impaired leases. Requirements of IAS 17, more extensive disclosures required, including a reconciliation between the gross investment of the lease and the present value of the minimum lease payments, the amounts due within the next year between years 2 to 5 and beyond 5 years. Disclosures also required on the amount of unearned finance income, unguaranteed residual values, contingent rental income in the year, general information about the lessor's leasing arrangements. Disclosure requirements under IFRS 16 are similar to those under IAS 17 and set out in paragraph 16.93 to 0.94. Disclosure is also required on operating leases under both ASPE and IFRS. You can refer to illustration 20-36 in your text to identify the differences between ASPE and IFRS for lessees and lessors. In general, except for some terminology differences, the classification between ASPE and IAS 17 is applied in much the same way under both sets of standards because of the initial classification of the lease. Illustration 20-36 in the text sets out major differences between that approach and IFRS 16. Accounting for an operating lease from the lessor's perspective, risks and benefits are not transferred to the lessee, so they would record cash revenue or cash and rental revenue and depreciate the asset on their books. Under ASPE, they would be required to disclose separately the cost and accumulated amortization of the property. Under IFRS, disclosures would be similar to those of financing leases, and the normal disclosure requirements for long-term assets would apply to that as well. Looking ahead, we just did IFRS 16, so it was issued in January 2016. So the new standard is effective January 1st, 2019, and it requires the use of a contract-based approach to recognize the right of use of the asset. So almost all leases, other than short-term and low-value leases, are now required to be included. And that's it for Chapter 20 on leases.